For decades, U.S. government bonds were considered the safest investment in the world, the ultimate place for investors to park their money. That perception wavered recently when two long-term Treasury auctions failed, sending yields sharply higher. The shift signaled something deeper. Global investors are starting to doubt Washington's ability to manage its ever-growing debt. Treasury Secretary Scott Bessent responded by issuing a record $100 billion in four-week Treasury bills. But instead of fueling new growth, the funds simply paid off maturing debt. For many Americans, the problem feels abstract, until higher interest rates reach their households. A 0.5% bump on a $300,000 mortgage adds about $125 to $150 per month, or up to $1,800 per year. Even car loans are affected, with payments rising by $20 to $25 monthly. It's a quiet reminder that the machinery of debt doesn't create prosperity, it just buys time. According to Goldman Sachs, U.S. consumers are now shouldering as much as 67% of the cost of tariffs. New levies have already added about 2.4% to core inflation, and analysts warn the figure could rise above 3% by late 2025. That translates into higher grocery bills, pricier clothing, and more expensive electronics. A refrigerator may now cost $150 more, a large-screen TV $200 more, and even a basic wardrobe upgrade adds an extra $5 to $10 per item. For a two-car household, imported gasoline could tack on $150 to $200 annually. Small businesses, especially those reliant on imported parts, are squeezed hardest. Component costs are up 8 to 12%, forcing owners to either raise prices or cut hours. For shoppers, the impact is subtle but relentless. Each meal out costs $3 to $5 more, while the family grocery basket has risen $8 to $10 weekly. One of the more unusual moves was a 39% tariff on imported gold bars from Switzerland, Canada, and Australia. The decision drove U.S. gold futures more than $100 above spot prices. Jewelry stores, faced with higher import costs, lifted prices by 8 to 12%. That means wedding rings and bracelets are now $150 to $300 more expensive. The ripple effect could weaken America's role in global gold pricing, shifting influence toward markets like China. In the long run, the dollar's credibility as a reserve currency could be tested. Since early 2025, U.S. consumer prices have climbed 4 to 6%, while many peer nations have seen declines. A $150 weekly grocery bill now costs about $500 more per year. Electricity bills are up $5 to $7 monthly, and winter heating costs could rise by $100 to $150 per household. Consumers are responding by cutting non-essentials. Restaurant visits are down, appliance purchases are postponed, and small retailers report losing up to 10% of customers. The chain reaction is clear. Weaker sales mean fewer hours for workers, reducing take-home pay for millions of families. North of the border, Canada is seizing opportunities. In June 2025, Ontario issued $2 billion in bonds without a single U.S. bank involved. Alberta followed with a €1.25 billion raise led by European and Canadian banks. For U.S. pension funds, this bypass means lower returns. Experts estimate annual retirement incomes could fall by $600 to $900 for those with $300,000 saved. Meanwhile, Ottawa is signaling it can live without U.S. markets. Canadian copper, once a reliable lifeline for American auto factories and housing projects, now faces uncertainty. A projected 5,000-ton shortfall could cause delays in Detroit and Texas, forcing plants to push back paychecks. For families, it may show up as $20 to $25 higher utility bills as copper-intensive grid upgrades grow pricier. Few things are as personal as a home. Canadian softwood lumber, long the backbone of affordable American housing, is caught in the tariff crossfire. A 35% tariff would add $50 per 1,000 board feet, raising the cost of a single-family home by $600 or more. For retirees on fixed incomes or young couples saving for their first house, that's not just an accounting detail, it's a delay in a lifelong dream. Another flashpoint is dairy. In July 2025, Canada imposed tariffs of up to 298% on butter and 245% on cheese once U.S. exports exceeded agreed quotas. The result, billions in U.S. dairy losses and price jumps for consumers. At American supermarkets, imported cheese has risen 15 to 20%. A 300-gram pack once $6.50 is now nearing $8. Meanwhile, some U.S. farmers are struggling with oversupply at home, cutting shifts and selling cows just to stay afloat. Even ice cream tubs have quietly shrunk in size while holding their prices. Coffee lovers are also paying the price. A 50% tariff on Brazilian imports, which supply nearly a third of U.S. demand, has pushed retail prices from $7 per pound in January to over $8 by June. By year's end, households could spend an extra $60 to $80 annually just on ground coffee. Small cafes face a sharper challenge. One New York shop reported an extra $400 monthly in bean costs, forcing tough choices: raise cappuccino prices by 25 cents, blend in cheaper beans, or cut staff hours. Beyond North America, global pressures loom large. China has doubled down on importing over 1 million barrels of oil per day from Iran, despite U.S. sanctions. At the same time, Beijing has invested over $200 billion in renewable energy and electric vehicles, reducing long-term oil dependency. For Americans, this means volatility at the gas pump and rising competition in green technology. A 30-cent rise in gas could cost families $400 annually, while Chinese dominance in battery production may undercut U.S. auto jobs. If Washington responds by tightening sanctions, Beijing could restrict exports of rare earth magnets, vital for smartphones, laptops, and defense systems. Analysts warn this could raise smartphone prices by $70 to $180 and laptops by $150 to $200. Since early 2025, the US dollar has fallen nearly 10% against major currencies. Foreign investors have pulled more than $60 billion from dollar-denominated assets, including $48 billion from treasuries. A weaker dollar means higher import costs across the board. Seafood is up $2 to $3 per pound, restaurant dinners $15 to $20 more, and SUVs cost $20 to $25 extra to fuel each month. What began as targeted tariffs has become something larger: a reshaping of global trade patterns, a weakening of U.S. financial influence, and a steady rise in consumer costs. From gold jewelry to groceries, from mortgages to morning coffee, the effects ripple through households in ways both subtle and profound. The challenge ahead is clear. If the U.S. continues to rely on tariffs and debt to prop up its economy, it risks not only higher costs at home, but diminished influence abroad. For millions of American families, the question is no longer abstract. It's whether they can afford the same life they had just a year ago.